capital structure, right? Capital structure, we are dealing with that now. Okay, so we started with that last class, I think. Right? We started with that in our last class, and I promised today that we are gonna jump straight to M and M, right? That big pronunciation there, we'll get to it. But just to do a recap, right? When we talk of capital structure, we're saying we're basically looking at the permanent structure within an organization in terms of the funding structure, right? Which can either be equity funded or it can be debt funded, right? And then I think I also did mention, maybe I'm not sure if it's here in the textbook or wherever, but still part of financial management, be able to distinguish between what we call a secondary market and a primary market, right? Secondary market and a primary market, both of which are very important to us as an organization or as financial managers, secondary market and the primary market. And I think I can recall saying the primary market is where we raise funds, right? At initial offer, where if you want to raise funds, you go to the primary market, right? Also, this is where you go and then you issue, say, you can either issue your bonds, right, which is your debt, your debentures, right? Or I don't know how you pronounce that, maybe debentures, I don't know how you pronounce that, but you basically go and issue those there. Or you can decide to go. So in the primary market, of course, you have the debt market and equity market there. So you can either go out there and you issue out. So equity is going to be in the form of ordinary shares, or you can issue out, say, your bond, which is going to be, or your debentures, which is going to be in the debt market, right? So remember, if you are the issuer in this case, you are the one that's looking for funds, right? So if the company wishes to raise funds, then they issue shares. On the other side, investors, what do? They buy those shares and they give the company money in exchange of those shares, right? So the ordinary shares, which are found in the equity market, right, basically give you part ownership or a claim in the residual interest of an organization, right, which is basically ownership of an organization or part ownership of an organization, right? So of course, I'm sure you remember again from your earlier years that there are private companies and public companies, right? Or normally, I think the ones that we deal with here, if it's a private company, it's going to be PTY, right? And then if it's a listed company, it's LTD. Those are the differences. So the differences in the names, right? But then the major difference is in how these ones raise funds, right? So the LTD, which are the publicly listed company, most of them would assume, right, because we are here in South Africa, let's say they are going to be listed on the JSE. They are traded, right? Then, so we've spoken about debentures and equity of basically debt markets where it's separated between. What are debentures, right? I think I recall again explaining that sometimes as an organization, you find that you need to raise, let's say, $1 million. Let's say $1 million. You basically need $1 million. That should just about be, God knows, maybe around 18 million rands. I don't know, 16 million rands thereabout. So you approach the bank, and the bank is going to tell you that, look, with the assets that you have, or let's say with economic conditions that are here, we can't, banks are in business, right? So they don't want to lose. So they say, we can't risk that much and take $1 million or 18 million rands and pump it all into one organization. We can't risk it all. Should you lose, then we are going to be at a disadvantage. Of course, in practice, there are a lot of measures that banks take so that they are not in a position where your debt runs dead, right? Where they are unable to recover that money from you. But then first of which is what we are talking about, doing an analysis, this analysis that we're talking about, that why should we give you a whole 18 million rands, you see? So if the banks fail now, of which it's likely that it's gonna fail at banks, what would you do? Then you can go to the debt market again, go back to the debt market, right? And then issue these debentures. So with debentures, we are basically gonna be breaking down this 1 million into chunks that are chewable, right? Something that you can stuff in your mouth, if I'm to put it that way. Break it down and say maybe break it down into chunks of $1,000, right? $1,000. So that should be, so $1 million is $1,000, right? So which means you are basically gonna go to the market and look for 1,000 investors that can buy each, for argument's sake, each buying shares worth $1,000. So 1,000 is something like 18,000. So people can somehow get around 18,000, I assume, right? So it's gonna be easier for someone to risk 18,000 than for someone to risk 18 million, right? So that's the reason why you find debentures in all these organizations, because they want to borrow it. You break it down now and say, instead of borrowing it from one individual, let's borrow it from a lot of people, right? So which means you can go on then and purchase your debenture, one debenture. So one debenture is basically gonna be worth thousands, for instance, like in our example here. So hence, if you have 1,000 people buying those debentures, then there you go. You have your 1 million, which is very easy, right, and very convenient for organizations. So, and then the primary market, when the organization now wishes to raise funds. Now we jump to the secondary market. Let's say you have bought those debentures now. After a year or two, these debentures should be redeemed, say, in 5 years, according to the agreement that you have. After a year or two, you then decide that no, you'd rather go and buy CAT, right? Because CAT has got a better return for you. So what do? You'd basically go again to the secondary market and resell your debentures to somebody else. Same as your equity, you can basically trade them on the JSE, which is basically reselling to somebody else, right? At what price? It might not be at $1,000, right? You might decide that you're gonna sell them at say 1.2, you gain yourself at $200 there. But sometimes circumstances can be very bad and you might want to sell it at $800, depending. So on the secondary market, really the forces of demand and supply apply here, right? So it's basically gonna be up to what the market decides. So that has got a lot to do with what happens on the interest rates, etc. I don't think we cover that here as yet, right? But at the end of the day, this price is going to be regulated in the secondary market. But why is the secondary market important to us as an organization? Because it determines at the end of the day the share price. If you go on the internet now and you look at, say, the financials of Vodacom, for instance, it's going to give you the prevailing share price at the reporting date, which is the statement of financial position date. They are going to tell you that a share was trading at, say, 800 cents, or maybe 8 rand, or you are selling at 80 rand, whatever they give you. So what does that mean for the organization? It's basically an indication. If that share price is going up, it's an indication of mostly the sentiments, right? What the investors think of our organization, right? It's mostly got to do with that. So obviously, again, it's not an isolated event, because what the investors think about the organization is gonna be linked with how we are running the organization. So assuming that we are running the organization well, then there's obviously gonna be a likelihood that there's gonna be positive sentiments there. So if you wanna raise capital, let's say our nominal value of our equities are 50 rand. We're selling each share initially at 50 rand in the primary market when we first started the company. But because the company is doing so well, the secondary market is actually trading those shares at 80 rand. So it means if we need to issue more shares now, we don't need to issue them again at 50 rand if we need to raise more money as an organization. Then it means we can simply raise those shares at a price of 80 rand, which is the prevailing market value of those shares. So which is very good for us. So which is why those investor ratios are important to us. We take them serious because they basically give us such an indication what's happening in the market. All right, and then about debt and equity, we spoke about, I think it's somewhere here, yes. We spoke about the advantages of debt and the disadvantages of debt. So, which means in your analysis, right, when you're gonna be analyzing an organization now, let's say, I think I spoke about this again one time. Sometimes maybe your friend or whoever comes to you and they have a company that they are running. They've given you the financials and they want you to invest in that organization. Let's say you're in an accident and you survived by God's grace and you got RAF. That's a lot of money, right? And then your friend, seeing that you have so much money and their organization is struggling, they then decide that maybe you could invest in that organization, come in as a shareholder there, right? So now, before deciding what to do now, you have two options: either to loan your friend money, or you can buy equities in that share, both of which your friend is going to receive the money. Right? But what you do before you do that, like any smart investor, you request for the financials, right? And then you look at, say, after looking at the statement of what we call those ones, the income statement, right? We have seen how much profit the company is making. Then you go straight to your statement of financial position. So your statement of financial position is basically going to show you the equity and the debt of the organization, basically the capital structure. Right now, it gives you a clear view now of how that company is financed. Now, you want to assess what are the advantages of debt now for the company, right? From the perspective of the company, what are the advantages of debt? And then what are the advantages of equities? So now, with debt, you want to look at things like, the most important one usually is that debt is cheap, right? And then we say, why is debt cheaper? The cost of debt is cheaper. We say because the risk is a lot lower than equities, right? The risk is a lot lower than equities. But what do we mean now by that risk? Usually, when you enter into a debt covenant or a debt agreement, you sign, right? You sign. The bank is not just gonna give you money and you just walk out. They will make you sign papers, right? Probably sign off your house or sign off your big property elsewhere. So that they reduce the risk of your debt going bad as much as possible. Like the bank doesn't want to lose, you see. So hence, the cost of debt is usually low as a result of these characteristics. So the debt holders, number one, because of these contracts that you enter into, there's a likelihood that they win, right? They are gonna get their money back and their interest back. And then number two, again, should push come to shove, it basically means a debt instrument is gonna be repaid faster than an equity instrument. So when the company is liquidated or is being liquidated, and we need to pay off people, the first in line is gonna be the debt instrument holders. We need to pay those ones first. And then what remains goes to the equity shareholders, which are the owners of the organization. So as a result now, that is why your equity is usually gonna be more expensive in terms of the required return. So anyone who's gonna be buying equity in an organization is gonna require a big return because they know the risk that is involved. So the higher the risk, the higher the return that is gonna be required, right? That's the first advantage there of debt over equity. Then the other advantage again is the tax shield. Most debt instruments are tax deductible, meaning that when you're going to be calculating I think this is the example that we have here. If you look at the tax calculation for an equity financed firm there at 28%, the tax that is paid is 112,000. But for a debt, the amount that is going to be paid is how much? It's only 84,000. Why? Because debt interest has been deducted before the calculation of our taxable profit or our taxable income. So we call that the tax shield. So hence, you'll remember in your calculations of the cost of debt, you always factored in a 1 minus 0.28, or you straight up made a 0.72 calculations to deduct that or to factor in that tax deductibility issue that we are talking about there. Right, back to our example now. So it's up to you now, okay, before we get to that example. So it's up to you now as an organization whether you are going to go the debt route or you are going to go the equity route, depending on how you assess those there. So from the organization perspective, of course, equity is expensive, like you already said. Equity holders are very demanding for that reason. But the advantage with those is they don't require a dividend all the time. They can always defer their dividend. So some of the factors that I mentioned in the last class was when deciding whether to go the debt route or the equity route to finance a project, then consider things like the cash flows, right, of the project versus the cash flows of the instrument that you wanna get. For example, if you wanna finance a project that's gonna cost you $1 million, right, and then the project is only gonna start bringing in money, say after 3 years, but you need to be paying interest from year one. You see, so which means you are gonna be running at a deficit for the year number 1 and year number 2, up until that project is able to start generating cash. You see, so under those circumstances, then you can consider going for equities, right? Because those ones you are not required to be repaying anything, right? So those are some of the things that you need to be considering. Maybe also the memorandum of incorporation, I think that's what it's called now. Consider that again. So which means, for exam purposes, you want to go and look at the authorized share capital, right? So what is authorized share capital is the cap. So in other words, you can't issue ordinary shares beyond your authorized share capital unless there's an amendment that is made. Right? So during an exam, don't just rush to say we are going to issue shares. Right? First, check if there's any information about the authorized share capital there. So once it has gotten to the cap, then your only option is debt. You see. And then the other consideration that you should make, going back to our example, is from the example of you now, you have RAF money, and you're deciding whether you should buy equities or buy shares. After considering, of course, your own needs, look at the advantage that debt has over equity. You see, with debt, you are not owning the company, you are simply there to get your interest and to get your capital back, which is very good and safe. But the advantage with equities now, think of when the instance when some years back Bill Gates started this company, and you could have bought equities in that company, you'd be a billionaire today. But maybe you got greedy and decided to get a loan, to loan them. Your loan remains loan, doesn't grow with the organizations. So you need to consider that. So you assess your friend's company and see, is it likely that this company is going to grow? So if it's going to grow, then go for equities and grow with the organization, right? But again, that all depends with you. So you can just check all this out here on chapter number 4, the beginning of chapter number 4, right? And then towards the end of the class, we introduced the issue of weighted average cost of capital here. And then starting off with the traditional capital structure theory. Right. So on average, or in general, the weighted average cost of capital gives you on average the required return from your funders, right? The required return from your funders. In other words, the minimum required return that you should generate to make your funders happy, right? So how do we get that? Of course, we are just weighting between the equity and the equity capital and debt capital, just finding the average between the two. based on proportion. So it basically gives you the weighted average. I think we had an example, a simple example on the calculations there in our previous session. Very simple calculations, right? So the traditional capital structure theory basically postulates that there is, let me think of the word again, let's say optimum, right? There is an optimum capital structure. So how do we find that optimum? It's at a point where your weighted average cost of capital is minimized. So the explanation that we had there was, remember, debt is cheaper than equity, right? Debt is cheaper than equity for the reasons that we mentioned earlier. So your cost of equity, this is why you see it running quite higher than your KT, which is your cost of debt there. So initially, your weighted average cost of capital, so your y-axis there basically gives you a point where it's an all equity financed company, so which is the point on the y-axis there. Then as you move to the right towards the x-axis, you are adding more debt there. So as you add more debt, equity shareholders can tolerate, I think we're talking about this again the last session, we're saying equity shareholders can tolerate debt, right, for a while because they benefit from debt, right? They benefit from debt in the sense that they are getting a return on their investment without pumping in more money into the organization. So it's usually very convenient for them to, according to the traditional capital structure theory. So as you keep, but then bear in mind that debt comes with what we call financial risk. And we say financial risk is the risk of default, to cut it short. The risk of default. So which is the risk that you are not going to be able to pay back the interest, neither are you going to pay back the capital portion. So that's financial risk. So because it comes with risk, it can be tolerated for a while for the benefits that you get. But as you keep increasing your debt, it gets to a point where the equity shareholders also start demanding a compensation for, a compensation for the addition of debt, because addition of debt means financial risk, right? So they desire to be compensated for that. So the higher the risk, we say, the higher the return. So that is why your KE eventually starts going up then, because they are not tolerating any more risk added, which is in the form of financial risk, right? But in any case, because KT is lower than KE, that's why your weighted average cost of capital is going to be dragged down first, right? Up until it gets to a very low point there towards the middle. But it begins to rise when your KE is rising, right? And then it rises even further when your KT is rising. So your KT is rising now under the circumstances that, someone, if an organization wants to loan you money and they not an organization, let's say a bank, they want to loan you money and they see that you already have debt, they are going to be demanding more, right? Because you are a high risk client now, they're going to demand more. So hence that KT is going up then. So this is where we ended last time. So the argument now is you need to structure your capital in such a way that your weighted average cost of capital is very low, right? So as we're gonna see much later, weighted average cost of capital is very linked with calculating the value of a company, right? So it's very much linked. So a low weighted average cost of capital actually means a higher value of the company. So if you wanna maximize the value of the company, then you need to minimize the cost of capital, which is the weighted average cost of capital. That one is going to shoot up. So we'll cover that a lot later when we're dealing with company valuations, right? We'll see the impact of that there. Right, and then these were the calculations there, so there's no need to do that here. Right? You just read through the heads, but there's no need to do that. So the market value of the company, that's what you see there, right? But at the end of the day, the market value of the company is going to be, if it's debt and equity financed, then the market value, we use the weighted average cost of capital there. which is what you get on the last one. So hence the value of the company is the annual earnings before interest and tax, and then you have adjusted there, you adjust that for tax, excuse me, and then you divide that by the weighted average cost of capital. So you will see that the lower the weighted average cost of capital, it basically means the higher the value of the company. It makes a lot of sense, right? Because if you are going to be dividing the numerator by a smaller number, then you expect to get a bigger amount, right, than when you are doing the opposite. All right, and then the M and M, right, the M and M. So these two here disagreed with the traditional theory, right? Some years back, that's in 1958. All right, so they proposed that there is no optimal capital structure because the advantage of debt would exactly be counteracted by the increase in KE, right? Such that the weighted average cost of capital will always be equal to the business risk. So that is their agreement. So that is their proposition there. So which means instead of, so every time the way the debt instrument or the cost of debt tries to drag down the weighted average cost of capital, it's going to be counteracted by the increase in your KE. That's the argument there. So how is that possible? So it's possible under the circumstances that if you are going to put in debt and it's your investors, right? It frustrates your investors in the form of your equity investors, then they are going to require a bigger amount, right? They are going to require a bigger return, rather. They will require a bigger return. So the return is going to be such that it will end up making the weighted average cost of capital to be equal for both an all equity finance company and a levered company, right? But these are the assumptions for the M&M. First of all, we assume that investors are rational, and then we assume that all investors have the same expectations about the future. Capital markets are perfect, all relevant information is freely available. There are no transaction costs, there is no taxation or no distinction between company tax and personal tax. And then firms can only be grouped into business risk or operating risk classes. And then individuals and firms can borrow at the same rates, and personal gearing is assumed to be a perfect substitute of company gearing. So yeah, those are basically the assumptions. But I'm sure having gone through this, you can already see that they are not so realistic, right? But very good for study, not that realistic. So they argued in general, just to sum it all up for you, they basically argued that through the arbitration process, the KE is going to be kept equal to, all right, the KE, or sorry, the weighted average cost of capital for a firm that is financed, of course, both by debt and equity, is going to be the same with the KE of a company that is all equity financed. How so? Through the process of arbitration. Right, but what is arbitration? Just to break this down for us, right? Arbitration occurs in a situation where, say, just to simplify it, right, in simpler terms, when we talk of arbitration, whether in finance or in economics or wherever you want to talk of arbitration, we are looking at two markets that are selling the same product, right? But the product is cheaper in one market and more expensive in the other market. So logically, what would investors do or buyers do? You're probably going to go and buy the cheaper one, right? Go to the cheaper market, and where possible, you buy it and resell it in the more expensive market. But what happens now with arbitration at the end of the day is the prices are going to be equalized as a result of that. How so? If you're going to be, if one product is cheap, let's just say, I'm going to use one example that I made again in the other class. Let's say tomatoes are cheap in the market A and expensive in market B, right? What are we going to do? We are going to go and buy a lot of tomatoes in market A and possibly attempt to resell them in market B. right, and make a profit. We call those arbitration profits, right? But what happens, the more we buy tomatoes there in market A, the price of tomatoes is gonna go up, right? The price of tomatoes is definitely gonna go up because of the increased demand. It's gonna go up to such an extent that the price will end up being the same. The price in market A will end up being the same as in market B. So that's arbitration process there. So the arbitration process basically equalizes those prices. So the only situation where they don't seem to be equal is when you factor in transport costs, etc. But once you factor in transport costs, you realize that it's better for you to buy them. They are basically the same, right? For example, if you wanna buy, I know avocados are a lot cheaper in Limpopo than they are, say, in Mpumalanga or in Gauteng. Right? So what would you do? You wanna go to Limpopo and buy avocados there. But once you factor in your transport costs, then you realize that it's gonna be a lot just the same as you buying them here, right? It's gonna be the same as you buying them here. You can't drive there, just buy 2 avocados, you see. So it's gonna be a lot convenient for you to get them here. So that's arbitration eventually. Markets have adjusted themselves in such a way that it's almost impossible for you to make arbitration gains, right? So back to what we are doing here. So if for instance, the weighted average cost of capital of firm A, which is financed by both debt and equity, is for some reason lower, right? Slightly lower than for a company that is all equity financed. If it's slightly lower, M&M were basically arguing that it's a temporary thing, right? It's a temporary phenomenon. Just the same as you would find that it's cheaper for you to get a certain product in a different province than here. It's just temporary up until once the arbitration process kicks in, those things are going to normalize, right? Those things are going to normalize. So for instance, if the KE in that company there, so let's say if the weighted average cost of capital in that company is low, right? It basically means that the KE holders or the equity shareholders are undercompensated for the risk that the company is engaging in, particularly the debt risk, right? The finance risk, right? Because remember, the foundations of the tenets of these are, once you increase debt, the equity shareholders are going to require more, right, as a result of that debt. So if they are requiring more, but it's not to the extent, or it's not big enough to push the weighted average cost of capital high, then it basically means they are being undercompensated. So what will they do? They will probably leave those shares, right, and go for an all equity finance shares, because they are going to get a bigger return there. So the only option that the markets are going to have is to adjust themselves there. So that's what we refer to as the arbitration process. So it's like if you are investing in an organization as an equity shareholder, and then 2 companies are the same, because now we are assuming identical companies, right? One is equity financed, and then the other is debt and equity financed. So in essence, we are saying the one that is debt and equity financed basically has more risk because of the debt fact. So at the end of the day, the required return of the equity shareholders must be big enough to compensate them for that debt risk. So hence, at the end of the day, the weighted average cost of capital needs to be tracked up. So to sum it all up, they argue that at the end of the day, the weighted average cost of capital and the business risk, which is represented by your KE, the cost of equity, is going to be the same, right? So the value of your company is not determined by how much debt you put in etc. It's basically going to be determined by business risk, right? That's what they argue today. But we don't really go into detail with this. Like I said last time, the only question that I've seen with regards to this in a while was when I think in the previous exam for MAC 761, where they were saying, do you think there is an optimum capital structure? Right? Do you think there's an optimum capital structure? So if we're smart enough, therefore, we would know that they are asking us to comment in terms of the traditional and the M&M theory. So like I mentioned earlier, you need to be balanced in your analysis, right? We don't just look at these things one way. Consider all possible angles, right? I don't know if we have any questions on this. So this here basically explains what I'm talking about here. You can just read through all this to appreciate, right? Just to appreciate what they are talking about there. But the only thing that's required there is to read through, right? And then next up, I think this one here, we are gonna deal with now in detail. In this one is gonna require some calculations, right? Some calculations, so which is gonna be helpful. I mentioned again in the last session when we're doing weighted average cost of capitals that we might be required to calculate the cost of these capitals, right? The cost of equity, the cost of debt, right? Which is not new, but we're gonna go through it again. So since today is theory day and we're left with 5 minutes, I can as well just go through, and then next time we deal with calculations from the question paper. Right, ordinary equity. So with ordinary equity, there are basically two methods that we can use there. So the first one that's given there is dividends based. It's gonna be dividends based, or maybe income based, as they will normally put them. So number one, it's either when there's a constant dividend, right, which means the growth rate of that dividend is 0. And then number two is when, say, the dividend is growing at a constant rate. So there is a situation again where the dividend is not growing at a constant rate, right, which is a multi-stage one, but we don't do that here. Right? We only deal with either constant dividends or dividends that grow at a constant rate. So those are the formulas there, which we'll probably know by heart later. So P is the market price, right? And then D1 is the next dividend, and then KE is the cost of equity. So you can either use that to calculate your P, which is the price, which is going to help you to find the market price of the organization, which we'll use in our weighted average cost of capital calculations. Or you can use this formula again by making KE the subject of the formula. You can basically calculate your KE, right? So which is your dividend, your next dividend divided by market price. So here we are assuming, what are we assuming? No growth, actually. Yes, we are assuming no growth, so which is a constant dividend. So just watch out for that, because I think it's so tricky that I remember missing it at some point, getting a lot confused with one question that I was asked. So we are normally used to where there is a growth there, where there is a G, we are told that your dividend is growing at 10% growth. Right? So please don't confuse constant dividends and constant growth, right? Constant dividends means you're getting 10 rand, 10 rand, 10 rand, 10 rand, 10 rand, 10 rand. So that's a 0% growth. And then a constant growth, you are basically saying if it's a 2% growth, then every year it's going to be increasing by 2%. So the constant growth applies on formula B, and then constant dividends on formula A. So this would work again if you are finding the values of your preference shares. So for the most part, your preference shares are going to be constant dividends, right? Hence, they are given as a percentage, like 5% preference shares. That basically represents constant. So there's no growth, so it's a 0 growth rate there, right? So with your preference shares, it's normally going to be that case. And then your dividends, since you want to increase them to stay with our organization, maybe you want to increase our dividends or have a certain policy that we are following there. All right, so here, what's going to be big is just the application of formula, right? We go to the scenario and we pick up. Now we need to do weighted average cost of capital. Then you ask yourself, what inputs, what goes into the weighted average cost of capital? Number one, is your cost of KE in this instance. So your KE, how do you get your KE? This is how you get your KE in the first instance. Look at what you're given. Are you given dividends? Yes, you're given dividends, and you're also given the market price, then you can get your KE. So your next dividend is the dividend after a year, right? So of which you can get that by, you can see there where D1, which is the next dividend, is D0, which is the dividend today, and then you increase that by the growth rates. By how? How do you 1 plus it's gonna give you that increase. All right. And then, okay, it's good here we don't do the multi-stage. I'm happy about that. Perfectly happy about that. Okay, so once you know how to find your KE there under constant dividends, that's basically applied there in your preference shares. It's the same thing. It's your D divided by the market value is P. So it's basically the same thing. Right, but the other method that we can use again when dealing with ordinary shares and equities is the capital asset pricing model, which I already spoke about. So there you look at the sort of things that you're given in deciding what method to use. So if you're going to be given the risk-free rate, the market rate, and your features, then you know you need to use your capital asset pricing model. So of which we are going to deal with that again. All right, and then debentures or debt, debt again, we're going to make use of our financial calculator for Excel. So on the next session, please come equipped with your financial calculators or your Excel spreadsheets. We're going to be looking at a comprehensive example, a very good one for weighted average. So we familiarize ourselves with the costing, also, yeah, with weighted average cost of capital, right? I don't know if you guys have any questions tonight. I don't know if we have any questions tonight. So next up, then we are going to be dealing with this that I'm talking about, the calculation side. Just going to be dealing with that. So all these here, you can just leave out the rest of that. We don't really need that. After we are done with our calculations for the weighted average cost of capital, and then I'd love us, I think we are going to skip chapter 5, right? Because chapter 5, hopefully we'll be discussing it when we're dealing with weighted average cost of capital, since there is capital asset pricing module, which is what we're interested in. So once that is covered, then we are jumping straight into chapter number 6, where we are going to be dealing with investment appraisal. This carries a lot of marks, so brace yourself for that. All right.